Welcome back to Switzer. Well, he's back. The global globe-trotting accountant Lance Lay is back in the country and he's studying his technical market chart. So what is Lance Lay of Accountancy Invest seeing in our share market future? Lance, thanks for joining us.
Great to be here, Peter. Thanks for inviting me.
Now, usually when you're on the show, we do a video clip and whatever, but for technical reasons we haven't got. So tell us what we would have seen if we had the clip.
Sure, Peter. So last time I came on the show was March 22nd during quite a few months ago now. And at that time, it was 2,344 on the US S&P 500. I said at the time that it would pull back a little bit, but ultimately I had a target that was 5% higher all the way at 2,472.
Yeah, yeah.
And of course, we got there just the other night. So
nicely timed, Lance, as always.
Nicely timed.
Okay. So the chart we've got on screen now, mate, is that where we are now?
Yes, of course. So that M you can see was the March 22nd show.
Good. Yeah.
2,344.
Yeah.
And the S lines were the pullback ranges which I thought it could go, but then ultimately I had a T, and your comment from the last show was buy the dips. Yeah. And I said, absolutely.
Well, I'm glad we gave good advice, Lance. Now, what are the charts telling you now? What's the big call for the US market going forward?
So we have hit those targets now, and so since March to go up 5% and hit a target of 2,472, which was already achieved, exceeded, and now we're sitting just right on 2,470. So we're smack bang on the target, Peter. We have to expect a pullback of some sort now. I don't expect a massive pullback. I think something like 2,418, which is that little S line, which you can't see because I've got a bit of detail happening there, but it's about a 2.1% pullback. I think it'll be healthy.
And seasonally speaking, the Yanks often do pull back around this time, don't they? And they come surging back over November, December.
Well, I certainly hope so, Peter.
Okay, well, take it from me, Lance. That's actually the historical inclination. Let's go to your second chart now, mate.
So the second chart is actually the ASX 200. We're currently at 5,768. Now, that was, I believe, it closed slightly higher. Yep. We didn't quite hit the target of T1, which is 5,998. I still think that's in focus. On the chart there, M marks the spot where I was last on the show in March, 5,688. It actually went straight up. It was by the end of May, by beginning of May, it actually was 5,956. You can see it spiked up, got very close.
Good call, a pretty good call, Lance.
It's pretty close, and now it's come off. I think we're going to continue to track sideways, maybe even a pullback along with the US market, but I think that T1 mark is still in focus, which is the 5,998, Peter.
Okay, the yellow line below, is that the 50-day moving average or
what?
That's
the yellow line below that with the S is the 200-day moving average. Okay. I think it'll hold between that mark and probably the line below that, which is the T3 mark. Really, Peter, on this chart, I also expected it actually to go down before it headed up. And what it has done instead is it's gone straight up and then gone sideways. Yeah,
it's like a consolidation around. They didn't believe in that level it got to, but then they don't seem to have a great appetite to sell off beyond the current trading range, do they?
Yeah, well, I mean, I think what's really been playing into this story, Aussie market, is of course the Aussie dollar, and we'll talk about that a little bit later, Peter.
Okay, let's go to your next chart.
So this is not good for your ratings, Peter, because it's a somewhat boring chart. Oh, good. I mean, the Shanghai index has gone nowhere. It has actually gone up some. I mean, it's really gone up nearly 6% since March. But for the Shanghai index, that's relatively stable. And the story...
Maybe they're starting to behave themselves like typical Western economies rather than the slam bam, thank you ma'am economy it's been for such a long time.
Well, the reason why I showed this chart, Peter, is because it really is important that we don't see the volatility that we have seen in the years gone by.
Yeah.
You know, for example, here on the chart there, it went up 120%, went down 120% in 8 months. I mean, this is terrible, right?
Yeah.
To go and so you don't want to see such huge volatility. What you want is a steady as she goes situation. The R1 and R2 represents a 36 band range, and I feel that we'll probably stay within there, which will be good for our market.
Yeah, and certainly we've seen the Chinese data coming through over the last 6 months has been better than expected. So you'd think that the data would actually sustain that slowly rising market there.
I'm hopeful. In fact, it's fallen below the 200-day moving average, come back up above it, and now it's sitting above it. I think that's a steady as she goes signal.
Okay, your next chart is about Aussie dollar versus the US, isn't it? And this is a very important issue for many stocks on the Australian market. What are the charts telling you?
I think we've got higher levels to go, Peter. I think that on the chart there, S, which is a really important support line, resistance line. What we've seen
S at 77.
S at 77.
Yep.
And what's happened is that sort of capped our rises over the last 22 months. You can see on the chart there, it basically over 2 years and 9 months went all the way down from 94 cents to all the way down to 68 cents. The B marks that bottom. The bottom there represents a 22-month period when you got B to B1 on the far right. It's been capped by 77 cents. And what happened, you can see on the right there, just of recent days, as soon as it broke out of the 77, it really just shot up to where we are now at 80 cents. I think we're going to go now to T1, which is 83.25. That's a 4.1% increase. And really T2 is in focus, which is 85 cents, which is 6.25%.
Yeah, and you're not alone, Lance. I know there was a call last week in Fairfax Press quoting a leading foreign exchange analyst who said 85, you can't rule it out. But that is going to be a bit of a challenge for our market because there are a lot of stocks, which are dollar sensitive. On the other hand, as George Baburas pointed out tonight, he believes resource stocks and commodity prices are going to help the resource stocks, and at the same time, it keeps strength under the Aussie dollar.
Well, exactly, Peter. I think there's two sides to this. The Aussie dollar's probably gone up because there's a greater demand. I think this is the reason why I mentioned in the Aussie ASX 200 chart, this is going to be an influencing factor. I think that this the dollar rise has been factored in somewhat, and so hopefully what that'll mean is that we can have a rising Aussie dollar. It'll go to at least 83, and still we'll hit that T1 target of 5998.
Okay, in the time we've got left, I know you haven't specifically drawn up a chart for this particular issue, but I know you're the kind of guy that looks around for anything that might really rattle the stock market. So I remember, I think it was 2007, about September, you got spooked by what you saw in Shanghai. You rang me on a Saturday to point out how worried you were, and that was a pretty good preemptive call before the market really did its nana in November 2007. Lance, you obviously do look for those external big market moving signs. Is there anything out there that currently worries you?
Well, I'm glad to say, Peter, that there isn't. I think that there are obvious things. I mean, in our market, you've got a lot of commentators talking about property prices, building, that sort of sector. There's also speculation that's overseas that could be a little bit overdone in China, perhaps. I think that I'm not seeing anything like when I called you out of the blue, like on a Saturday, to warn that wow, something's going to give, and it's going to give in the short to medium term. I think we're looking okay for now.
Yeah, 'cause I also remember you once made the reference point that you're quite surprised at the movement of gold before September 11. Was that the case in point?
Absolutely. You know, September 11, it's quite interesting. The price of gold significantly went up, and if anybody would care to have a look at the charts, in the lead up to September 11, the price already moved. And in fact, what happened was after September 11, when you would have thought if the matter was indeed a shock, as it was to the most of us, gold price should have gone up. It actually didn't do that. It actually sold down, as if you were preparing for the news on the lead up, and then people sold down on the bad news to take profit.
Yeah. So basically, you know, you are always doing a 24/7 watch for anything that's really weird that gives you the kind of feeling that maybe there's, like, for example, you know, it was obviously the problems in the US financial system around those crazy loans they were making that ultimately brought the system down. But you started seeing it in some unusual movements on the Shanghai index, wasn't it, or something?
Correct. And you'll also notice that when Brexit happened, there was a period of concern. And that was borne out on the charts, and the targets were actually hit on the low side, you might recall. If you look at those charts, some 3 to 4 months before the lows in the pound were hit, we talked about on this show. And so I'm not getting these heads-up signals at the moment, which is a good sign.
Excellent. Lance, thanks for joining us.
My pleasure, Peter.
That's Lance Lowe from Accountancy Invest. That's the show for tonight. Thanks for joining us. We'll see you tomorrow night.